computer-driven things, you know, where people buy stocks for a second and own it for a second. I mean, I think that's a waste of time. I think it's disruptive.
Well, it bothers me that people are very dangerous when they invest. This word "play the market," that's a dangerous term.
Yeah.
When I was running Magellan, 1 out of every 100 Americans was in the fund.
Yeah.
These are people that $5,000 and $10,000 was a huge deal to. So when the market went down, you felt really badly. I mean, it's really the pressure on you when it's average people's money.
Yeah.
That's overwhelming. And you're nice enough to say nice things about Magellan, but in those 13 years, 10 times it declined over 10%. You know?
But if you do some work, do some research, know what you own, look at the research, look at the balance sheet. If you could add 8 and 8, get fairly close to 16, you can find out this company has lots of debt, no cash, they're in trouble. You shouldn't own it. So a little bit of research. People are careful they buy a refrigerator, careful they take a vacation. And they'll put $5,000, $10,000 some stock to hear on the bus or to party. That's dangerous. Imagine if you were in a mall the last 50 years. You would have seen Gap when it was hot. You would have seen Limited when it was hot. You would have seen when it was not hot. You would have seen when they were starting, people weren't excited about Gap anymore. And then you do some research, say, well, gee, there's a lot of limited stores, but we're only at 20. You know, they can go to 400. So you see a company. I did really well with Dunkin' Donuts, a local company. I did well with Stop and Shop. But people could see that this is really some people showing up, or I guess the Sunglass Hut, no one's there anymore. So I mean, that's research. That's fundamentals.
So
but you don't leave the mall, though, and buy that day. You have to do some more work. Well, the way you beat the index is you avoid the stocks to go down. You avoid the steel companies and the oil companies and Sears and Penny and where the companies are deteriorated. I mean, companies are dynamic. Behind every stock, there's a company. These are not lottery tickets. So you're trying to find the companies within the S&P 500 that are doing better. They're going from crappy to semi-crappy to good. That might take a couple of years, or they're going to grow for a long time. And you're trying to avoid the companies that are going south. That's how you beat them. Or you find some companies outside the S&P 500 that are great companies. CarMax was not in the S&P 500. They went up 200-fold. There's a lot of companies that enter, and a lot of their great performances before they go in. 1989, I'm at home, and the phone rings, and I thought it was one of my friends, but one of my daughters, I think it was 6-year-old Annie, picked up and said, gee, guess there's a Mr. Buffett online? I said, this got to be a joke. So I pick it up, and this Warren Buffett, I'm from Omaha, Nebraska, you know, I read your book, my annual report's due in 2 weeks, can I use the line? He said that all in about 7 seconds. And I said, that's great, I'd love to do it. What's the line? He said, I love this, it's been waiting to do this. When you sell your great companies and add to the losers, it's like watering the weeds and cutting the flowers. He said, I want to put it in. He said, if you ever come to Nebraska, you don't call me, your name will be mud all over Nebraska.
I have also enjoyed reading the 2 books by Peter Lynch. And I see a lot of commonalities between the two of you, the way you think and your philosophy, etc. I'd certainly appreciate it if you'd make a few comments on what you think of Peter Lynch, the things he says in his 2 books, and the advice that he gives to investors. Thank you.
I know Peter. I don't know him well, but we played bridge together in Omaha, as a matter of fact. And I like him personally, and obviously he has an outstanding record. And he has written those 2 books which have been bestsellers about his investment philosophy. I don't really have anything, you know, I'm not going to embroider on his. There's certainly a fair amount of overlap. There's some difference. Peter obviously likes to diversify a lot more than I do. I mean, he owns more stocks than the names of companies I can remember. I mean, but that's Peter. And I've said in investing in the past that there's more than one way to get to heaven, and that there isn't a true religion in this, but there's some very useful religions. And Peter's got one, and I think we've got one that's useful too. And there is a lot of overlap. But I would not do as well if I tried to do it the way Peter does it, and he probably wouldn't do as well if he tried to do it exactly the way I do it. I like him personally very much.
Several times we played bridge together. We've had several meetings. Great guy. Well, obviously the market's gone up tenfold since I stopped running Magellan. So you make more money on the upside. The market's going to be a lot higher in 10 years from now, 20 years from now, 30 years from now. Trying to predict the market is really a waste. I don't know what it's going to do. It can go down. When I ran Magellan, 13 years, it declined 10% or more. 9 times the market.
Wow.
I had a perfect record. I went down more than 10% every time. Wherever the market went down, I went down more. But over the long term, the upside is more than the downside. So you got to say to yourself, do I need the money in the next month? Do I need the money in the next year? Do I have kids going to college? Do I have a wedding coming up? Then you're a bad investor. If you can keep putting money in, you have 5, 10, 15, 20, 25 year, you should do well. I saw the textile industry deteriorate. I was recommending all the stocks on the way down. I saw the shoe industry go away. Industries can go from terrific to terrible. There's a great expression in the textile industry that helped me a lot.
Textile industry, yeah.
It's always darkest before pitch black. Just when you think things are terrible, they get terrible squared. I mean, so just because industries are getting bad, that's not a reason to invest. Wait for things to get better. Because, again, somebody might be involved in steel. They might be involved in coal. They might be involved in iron ore. They might be involved in plastics. They'll see it, aluminum pick up before I do. So that's a cyclical turnaround. That might last 2 or 3 years. You might see it way before Wall Street sees it.
On the positive side, information to the public is so much more available today. When a company releases their numbers and they have a call, it's open on the web to everybody.
Right.
All the information. We used to wait for the mail to come to see what Nike's inventories were like. You know, I mean you find out we get in our library in the first class mail. So all this information. So the investing for the average person now is much clearer. They know the same thing as I do.
Yeah.
They, all this, you don't want to invest in a company whose balance sheet is, they got $8 billion in debt and they have no cash and they're losing money. That's a terrible combination. You get all the information now. So information is a lot better than it was. The key thing is when the stock goes from 10 to 6, if you understand what they do and you know they're financially solvent, you're fine. If you don't understand it, you can call the psychic hotline. But if you don't understand it, you're probably going to do the wrong thing. If you understand exactly what they're doing, it's gone from 10 to 6, you'll buy more. If you're confused to start with, you'll say, well, there must be something wrong there. And then you're out. And then a lot of times stocks are going to decline. I mean, some of my best stocks have gone from 18 to 8, then to sometimes to 40, and some have gone from 18 to 0. But at least I wasn't adding to it on the way to 0. A lot have gone to 0.
So if it's going down, you're not adding to it? I mean, sometimes you are.
If the fundamentals are getting better or the same.
Yeah.
But if they're deteriorating, I'm going to leave. Imagine if you're in a mall the last 30 years.
Yes.
You would have seen The Gap. You would have seen Best Buy. You would have seen Circuit City. You would have seen these companies that are crowded doing something better. And they're buying biotechnology stocks or oil companies. It makes no sense to me. If you're in the steel industry, you see it go from awful to better.
Yeah.
Why don't you buy a steel stock?
What do great managers do?
Well, there's two types. You have Fred Smith who comes up with an idea called Federal Express.
Right.
Then he had to grow it. And that's really tricky. Sometimes people can just do the idea part. He did all the parts.
Right.
And then there's Lee Iacocca had to turn around to trouble with Chrysler. And even more challenging, a giant company like General Electric to make something good better. I mean, that's really hard. So all these people basically were problem solvers. And they had to manage people. And one of the things that surprises people, they don't even understand the definition of management. It's getting things done through others. It's a lot easier to do something yourself. If you have somebody else do it, and lots of people, obviously you're managing people, and sometimes you have to encourage them, sometimes you have to push them a little hard. I mean,
Inspire,
people are different.
motivate,
It's hard.
encourage.
But you have to understand what they want. You have to work with them. You have to explain yourself. You have to set goals. And you have to be a leader yourself, and you have to put a lot of effort into it. And you have to make mistakes. And there's a real amazing difference between being persistent and being stubborn. And I think great leaders could say, this is
Persistence is good, stubbornance bad.
Persistence is terrific. Stubbornness is terrible.
But do great managers listen?
Yes, they do. Absolutely. Categorically. Something else. So
Can you be greedy in your business?
Yeah, I think sometimes I call it the 3 C's. It's called complacency, concern, and capitulation.
Yeah.
So you're complacent is the I don't call it greedy. Just everything's going right. You sort of forget to check the facts. You say things are starting to slip in the company. Not the fundamentals. They're starting to mature. There's some competitors coming along. So being complacent is the worst one.
And that's the one that happens most often?
Yeah, well, unless you're working hard. If you're working hard, you're always checking with competitors, you're checking with customers, suppliers.
Right.
You're trying to do work to find out, is this company still early? Do they have years and years of growth ahead of them? Then you stay with it, no matter, even if the stock goes down. You asked a question earlier about the ability to listen.
Right.
I think that's the skill. Because when you're talking to a company, if you ask all these questions, it's like a monologue. Then you say at the end, is it something I've forgotten? Or,
Me too. I say it all the time.
You want to have them say, by the way, a year ago when you were looking to see what things are going to be like, how has it come out?
Yeah.
What have been surprises for you? So I'm always listening to what people say. So it's more listening rather than asking, and also being nice. Almost none of it was pension fund money. It was almost all individual speaking.
Right.
It was incredible, that thrill.
Yeah.
I got letters when the market went down to 87. My fund went down like a rock.
Yeah.
People were writing letters to me, cheering me up.
Oh, really?
Yeah, oh yeah. No complaints.
Mr. Lynch, you've done well for me.
Yeah, no,
I just
you're
want you
hanging
to know.
there.
I know, hang in there, boy.
We'll be okay. No, it's amazing.
Don't give up now, Peter.
No, it was. And I meet these people all the time, at airports, all around. They're still. It was wonderful. It was the greatest thrill of my life. Other our children and my wife. managing money for other people.
Now, we've seen new highs.
Right. I think the market is fairly priced on what's happening right now. You have to say to yourself, is 5 years from now, 10 years from now, corporate profits have grown about 7 or 8% a year. That means they double, including dividends, about every 10 years, quadruple every 20, go up eightfold every 40. You know, I think that's the kind of numbers you're interested. That's better. A 10-year bond today is a little over 2%. So I think the stock market's the best place to be for the next 10, 20, 30 years. The next 2 years, no idea. I've never known what the next 2 years are going to bring.